Welcome back to another episode of the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 125. On today's episode, we're going to talk about earnings, and we're also going to talk about entry points. Because since last October, stocks have done a lot of just going straight up, and I keep getting questions about, when's a good entry point to get into some of these names. So we're going to talk about how you determine that. And then also we're going to talk about earnings, the earnings that happened this past week, the earnings that are coming up, the importance that it's going to have for the market over the next couple of weeks. So let's get to it. Get your mind right. Let's get to work. Well, as always, welcome back to the program, everybody. So busy week here. We have another good week for the market. Believe all indexes are positive for the year, which I know we're not that far into it, but it's nice to see. And so we got a lot to talk about today as we look here at earnings season. We've had earnings this past week. We'll discuss Tesla's earnings. We'll discuss some of the big companies that are reporting this coming week, and just kind of discuss some of that. But I really wanted to talk about entry points and determining when you should get into a stock. How do you determine what would be a good price? And so we'll just kind of have a little discussion on that. And hopefully it'll help you make better decisions when it comes to getting into some of these companies. So way back in the beginning, episode 125 here, but I know that way back in the beginning, one of the first things that I discussed was having you design a portfolio of $100,000, looking at, it's the hardest number for somebody to achieve is getting to a $100,000 investment portfolio. And so, you got to design it before you can get there. So that was the challenge, the homework, if you will, was to go write down the names of the companies that you wanted to be invested in. And so, again, I encourage you to do that because especially times like this, when you have, stocks, it's amazing, right? How different, what a difference a year makes. A year ago, I'm telling people to be patient, to invest in companies, and now companies have basically gone straight up. And so now it's like, okay, when do I jump on the running train, if you will? And so you really have to think about, okay, again, it's the same stuff. It's consistency, it's discipline. So what companies do you want to be invested in? You write those down, you start watching the stocks, you start looking, and you have to start thinking about, okay, NVIDIA, did I miss it? Microsoft, did I miss it? All of these kind of companies. It doesn't mean that you missed them. It just means you have to have a disciplined methodology for getting into those names. And so, you look here and you just have to, when you start looking at the charts of these companies, I'm going to pick Microsoft, for example. So they're going to report, Microsoft reports on Tuesday. So when you look at Microsoft reporting, obviously, they have done very well since their last earnings report. Since the end of October, let's see, October 26th, Microsoft was $327 a share. It's now $403. It's getting price target upgrades to about $450. Microsoft is sitting right at $3 trillion in market cap. So Microsoft and Apple keep going back and forth as the most valuable company in the world. So, another $50 is a massive amount of additional value to Microsoft. And so, but if you go back around, November, December, Microsoft had a hard time getting above 380. So that 380 number was resistance for them. And this is more technical trading, technical analysis, not fundamental analysis. But we use this technical analysis to help us find entry points. So that last, resistance level of 380 will now be support for Microsoft. So that 380, if it were to pull back to 380, you could probably start to add some shares there. it would be a good entry point for you. But when they report on Tuesday, it's all going to be about obviously how they've done, but the guidance is going to be very important. And so Microsoft came out with Copilot, which is their version, their AI tool that they're going to implement throughout all of their products. So Copilot's going to be important, but it's going to take a little bit for that probably to show up in the quarterly numbers. So, depending on their earnings, their guidance, you might get a little bit of a pullback. So again, it's more about like how the market works more than it is about the company. So you have to think about in general. We discussed that the largest companies in the world now make up 29% of the S&P 500. So that's Microsoft, Amazon, Apple, Meta, Alphabet, which is Google. Those are now 29% of the S&P 500 index. And so if 50% of all trading is computerized trading on a daily basis, those big companies, especially during earnings, when you have hedge funds, maybe, other type of investors who are doing swing trading, they're basically trying to place their bets, if you will, on the earnings of these companies. And so some of these big names become a source of funds, meaning the money has to come from somewhere. Let's take some money from, some of our best winners and let's shift that money over. So, that might provide an opportunity if one of these slips up, a la Tesla, for you to be able to get a good entry point that you might not have thought you were going to be able to get. So, and when you see these companies report, if you're watching it very closely, there's almost like two things that happen. So when the market closes, Microsoft reports after the close on Tuesday, the first thing that comes out is going to be just the numbers, right? So they tell you what their earnings per share was. They tell you what the revenue was for the quarter. They give you just the numbers. They give you forward guidance. Well, they release the numbers, and then a little bit later on, they will actually have their earnings call where they can actually add some context and, kind of build up the story or build out the story. So you have to be very careful. I've seen a lot of mistakes where somebody trades just on the earnings, numbers, and maybe the stock drops or whatever. And then all of a sudden, when they have the earnings call and they're able to add some context, the stock recovers. So just kind of be careful. But you look here this past week, there were some really good earnings reports. You look at Netflix. Netflix had a tremendous week. They went from $491 a share and jumped up to $554 after earnings. A tremendous jump there. And then they ended the week at $570. So Netflix had added more subscribers than everybody thought they were going to add. They actually added the most subscribers since the COVID quarter when everybody was staying home. So Netflix definitely had a nice week, and they're still not back to their all-time high. If you can believe it, their all-time high is around 700. So 570, it's been a long road back here. But 260 million subscribers to Netflix is pretty tremendous. So you have their good quarter, and then we need to talk about Tesla's quarter here, where Tesla went from 207 down to 183. So this is the first time that Tesla has been this low since last May, and the lowest they've been in a year is $164 a share. So, Tesla having a little rough go of it. I think 2024 is going to be a rough year for Tesla. It doesn't mean that there's anything wrong with them. It doesn't mean that they can't recover. I just think, companies, the natural cycle of things, they're trying to get production of the Cybertruck up. They're working on a new model. Infrastructure for charging stations is coming out. You have the double-edged sword of Elon Musk, which is, I think, getting very tiring to a lot of people. And so, I've looked at some pretty good analysts that follow Tesla, and they said they would be interested in around the 180 level. One of the best professors at NYU tracks this stock a lot, and 180 is his entry point. And so, I look at this and why everybody's chasing everything else, everybody's kind of leaving Tesla over here to die. I mean, that's when I start getting interested in these types of companies. So again, it's, maybe Tesla's not going to have a good year, but it doesn't mean they're not going to have a good 5 years. So think about things a little counterintuitive than everybody else and look at the companies that, maybe are a little bit out of favor. And if they're on your list, start to look at them. So, Tesla last year was $281. You're getting $100 off of that. And so, it allows you to be, again, like we always discuss, be disciplined. If you like Tesla at 250, why do you not like them at 180? Right? So this isn't a recommendation for Tesla, but it's just a concept on, make sure that just because a stock is getting beat up or they're in that lull period where, the business is maybe going through a little bit of a, revamp or cycle here, that you don't just let it turn you off. I mean, this is kind of the mistake people make where they're just chasing all the things that are going up. And some of those are good, and you can a little bit, get into those. But again, discipline, sticking with some of these could provide you a good, a good base to get into to get into a company maybe you've been watching for a long time. And Tesla is, obviously, Tesla's always been one of the most shorted companies in the world. And last year they were like short sellers. People betting against the stock lost more money on Tesla than any other company. So, the bears, if you will be coming out trying to make money off Tesla. So I would, recommendation would be to buy some shares. Start small and then slowly add to it over the year, which is probably what I'll do personally, because you're just never going to be able to time it perfectly. And so if you invest in it here, you got to commit to yourself to buying a little bit more. So, but we'll see. And so this week is an important week. We have Apple reporting, Microsoft, we have Amazon reporting. So a big week for companies reporting. I was looking at Starbucks the other day. Starbucks, I believe, is going to report again this week. It hasn't been looking good. It's definitely been in a lull, getting close to a 6-month low here. I think they're kind of set up. I don't think their quarter is going to be that great, but I think it's kind of priced in. And so, again, when it comes to earnings, it's about expectations. What are the thoughts on this? What are the expectations? How to, and so that provides, how the market reacts to it. I know that, talking to students, talking to clients, sometimes you'll have a stock that has a really good quarter and all of a sudden it sells off. Well, how much did it go up into the quarter and then sell off? If it's already gone up 30 points, 40 points, whatever it is, 5%, 10%, whatever is easiest for you to think about. I mean, if it's already gone up that much, how much of the good earnings are baked into that expectation before the stock reports? So again, it's not about just trying to make money off of one earnings report. It's about maybe I use earnings more of if somebody slips up, I use that as an opportunity to get entry into the position. If a company does really well, I'll trade a couple shares out of it. I will basically go back to that trading around a position episode that we did where, I take some off the table, and then if it comes back down, I put it in, and that's what active money management is, right? So, it's all about having a system, being disciplined with your system and your investment strategy. American Express finally had a great quarter. From October 27th at 140 a share, American Express now broke 200, which is great to see. Great company. We've mentioned this one before. Ton of young card holders, young GZ, Generation Z card holders baked into American Express. Better credit quality on their users. And so just a very disciplined, good, solid company. So it's nice to see that finally showed up in the numbers. I'm excited to see what American Express does from here. And so that's one that we've talked about for a while, looking at. It's one of those it's one of those nice feelings where you follow a company and then all of a sudden, the discipline and the execution from the company shows up in the results versus a disaster like Disney, who is one of the worst performers over the last 5 years. Disney's got some real issues. So if you hold Disney, the stuff coming up about, Bob Iger, who's the current CEO, was the CEO a couple years ago that left. And then the other Bob came in and basically all these reports that he never really gave him a chance, never really moved out of the office, systematically, discounted all the CEO replacements. And so ESPN is a trouble spot for Disney with sports going to streaming and the cost of ESPN. ESPN is just a hard investment right now. It's gosh, and it shouldn't. When you think about Disney, you think about all the characters they have and how important they are, and the money that could be made. But they've made too many Marvel movies. All the Marvel movies started looking the same, except they just kind of changed the color. And so Disney, it's got its work cut out for it. So if you're an investor of Disney, I think it's going to take a lot of patience on that. This could be one of those that you sidestep. Might be easier to make some money somewhere else for a while. I don't know. I want to like them, but I can't. I want to like Disney, but I just cannot. I just cannot do it. I think their quarter is going to be messy, like it usually is. They're not really. They don't pay a great dividend. You're not getting paid to wait for this to get better. Same thing happened with 3M. So 3M, their most popular product is the Post-it note. They dropped 10% on earnings. Just an old stalwart type company. They pay a great dividend. They're paying 6%. We'll see if they keep that up. But if you look over the last 5 years, they've gone from $200 down to $95. There's just not a catalyst really to own this except that it's cheap. And so that brings up a very good point. We need a catalyst if we're going to invest in a company. Now, 3M, you could make a case that the income or the dividend is a reason to invest in it. But just a stock being cheap or a company being cheap, that's not always the best investment philosophy on why to get into it. You really need some better catalyst for putting your hard-earned dollars into a company like this. You might be waiting a while. So we'll see. If you got a long enough time horizon, I guess anything could work out. But when you're looking at this again, think about companies that you're invested in. Why are you invested in them? When you hear the earnings call, think about, is the thesis still intact? Is everything doing well? Is it what I expect it to be doing? And then you manage that based on the expectations. And if people sell out or whatever, you use that as an opportunity to get in. So I still think back, kind of just going back here, finish my train of thought on Tesla. I think that the risk on Tesla would be Elon Musk and a lot of the political stuff that he's doing right now. That double-edged sword is not great. I think the Twitter thing has been just an absolute. Maybe Twitter hasn't been a disaster, but the time it's taken him away from what he's doing other places, to me has been. But when I look at the competitors, a lot of these other brands, the old brands, if you will, the old guard, are reducing their EV production. And, I think that bodes well for Tesla long term to be able to maybe pick up even additional market share, increase their margins. We talked about how their chargers are the only ones that are working. So again, put it on, if it's a company you're interested in, put it on your watch list. A lot of these, put them on your watch list and just kind of see. My best expectation for earnings, Apple, I think that they'll do better than people think. Tim Cook is a master operator, so I think he'll do well. And then I still look, I look at Amazon. Amazon is still not back to its all-time high of around 175, 176. I think they're getting a lot of their cost stuff under, in order, bringing their costs down. And I think that is going to be a very good stock for the year and for the upcoming year. So I'm looking forward to seeing all of those. And again, just to kind of sum this up, when you look at some of these companies that you want to invest in, look at their earnings report, pay attention to their earnings report, see what they're reporting, see what their guidance is. Tuck that guidance away. It doesn't mean you have to buy it right away. But again, after companies report, it's going to turn back to all the political stuff that's going on and all the election stuff. And so you might have little things that cause the market to sell off. And if you already have the list of companies that you're interested in buying, use that sell off to get a good entry point on those. And when it comes to the entry points, look at where the chart starts to break down. Where was the last, the resistance point, or where was the last low on it? And is there going to be support at those levels? And so you use those kind of things and you combine them, and then all of a sudden you put together your investment strategy. So let's see how this week goes. A lot of stuff, a lot of moving parts, kind of an in-between earnings season report here, and we'll see. So next week we'll report on all the big guys. It'll determine how the market does over the next couple of weeks. So we will check back on that. So I hope this has been helpful for you. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.